right, our next guest says institutional investors are no longer risk adverse due to strengthening economic indicators. John Herrmann is one of our Bloomberg Best guests. Bloomberg Best means we bring you only the best people on the economy. What we've done, we've crunched the numbers to find the most accurate forecasters in the world. John is one of them. He is senior fixed income strategist at State Street Global Markets in Boston. John, great to have you back with us.
So good to be back.
Well, it's great to have you here. A couple things I want to talk to you about. First of all, I want to talk to you about what's been floating around in the markets as of late, and that is the outlook for higher rates, specifically the discount rate. Do you agree that we'll see it sooner rather than later, an increase in the discount rate?
Yes, I mean, absolutely. I know the discount rate is not meant to be a policy tool for the Fed in terms of, stricter or tighter monetary policy, that kind of thing, but the data is strengthening. The market needs some kind of signal from the Fed, either in terms of more flexible language, in terms of their very strict, dogmatic, dovish language. They need something, either more flexible language, or they're going to have to just start moving the discount rate, inching it up step by step, as a way of just appeasing the bond vigilantes in the market. And that's our take, because we really do see the economic data strengthening over the next several months, and we think the economy is actually accelerating as we transition from first quarter into second quarter.
John, talk to me about the strengthening economic indicators, because in some ways we've had still a bit of a mixed bag, and still when you look at some of those aspects of the jobless era, that's still problematic.
Yes and no. The jobless claims is something very subtle that's going on with the jobless claims. The seasonal adjustment factors may actually be skewing the numbers to be a little bit higher than what they really appear to be. And we actually think that over the next 3 weeks, that the non-seasonally adjusted jobless claims are going to break the 4 handle and break into the 3 handle. So we haven't seen that since the fall of Lehman Brothers, almost a full year and a half, almost, 2 years ago.
Right.
So we think that's something very important to take note of.
But John, the number of people getting unemployment insurance rose. Also, the number of people getting extended benefits rose. I mean, how does that factor into your thinking here?
Okay, so we have to be, a little bit careful. That movement is a little bit lumpy. It's not the most precise measure. It wiggles around a lot week to week, and it probably was influenced by the bad weather in February, because that reading that we saw on the emergency unemployment really was a February number. So it's likely impacted by the weather in February.
What about the low inflation? Most times we'd be happy to see these low inflation numbers, but some of my earlier guests say maybe that's not a good sign. It's a sign of an indication of a significant shift from these developed economies like the United States to those emerging economies where we're really seeing the growth. They're having inflation problems. It's a sign, that's going to have long-term consequences.
We're following, there's 2 risks out there, basically 2 risks out there we're following very carefully, and they're the risks that are working against our call for an improving and strengthening economy. One is this inflation number, and the second is what we think is going to be continued soft housing sale numbers for several months here. So those are the 2 things we're watching. In terms of the CPI, the core CPI really does run the risk of, falling to 1% by early part of the summer, and that's drifting very far away from the Fed's definition of price stability, which is a range from about 1.5% to 1 3/4 or 2%. So we're really drifting in the wrong direction. And for a person like Ben Bernanke, who's running the Fed, Bernanke is very concerned about deflation risk. He has a long history of being very concerned about deflation. So that's going to be the sort of thread of the needle going forward this year. We're going to see strengthening growth, and yet the inflation numbers are going to be very, very tame.
John, I know you've been well above consensus when it comes to those GDP estimates. Anything out there that's causing you to change it, maybe rein it in at this point?
Not reining it in, actually dialing it up just a couple of notches here. What we see really seriously, we're seeing strengthening industrial production as we transition from first quarter into second. We're seeing retail sales improve as we transition first quarter into second. We're seeing inventory stockpiling improve. We're seeing business CapEx spending improve. The federal government spending is going to be dialing it up. So basically, we're above the street, well above the street in terms of GDP outlook for the first quarter. We're closer to 3.6 or better. And for the second quarter, we're looking like closer to 3.7, 3.8. So we're well above the street. Street's around 2.8.
All right, got to run. John, great to talk with you again. You have a good weekend.
It's great to talk to you.
John Herrmann at State Street Global Market.